Number 2, stocks. Stocks are much simpler. It's basically having ownership in a company, whether it's a small piece or a large portion. For an example, if you buy an Apple stock, you own a piece of Apple. When people say stocks, they're not all talking about the same things. Stocks get grouped into categories because different types of companies move differently. Now remember, stocks is one of the main big buckets we talked about earlier, but inside this main bucket, there's subcategories. So let's go over some of them right now. Number 1, a large cap stock. A large cap just means a large company. These are the big dogs. Think Apple, Microsoft, Amazon, Google. They usually are more stable and they move slower than smaller stocks, and they already dominate their industries. Think of a large cap like a large cruise ship. They take a lot to turn, but they're not flipping over easily. Next is a mid-cap stock. A mid-cap stocks are the in-between companies. They're not startups, but they're not mega giants either. They're still growing, and they can move faster than larger caps, which means larger companies, and they have more risks and more upside. Mid-caps are like speedboats, faster than cruise ships, but still somewhat controllable. Then we have small caps, which means smaller companies. They move very fast and can explode up or collapse down. They're more sensitive to news and rumors. Think of small cap stocks like the roller coaster of the stock market. It's higher risk, higher reward, and also higher stress. Lastly, number 4, growth versus value stocks. Now, this is technically not a category, but it's important to understand because stocks also get categorized by how investors value them. Number 1, growth stocks. Growth stocks are companies people believe will be much bigger in the future. They reinvest profits, focus on expansion, and are priced on future potential. That means they can be very volatile. They react strongly to interest rates, and they dominate indexes like the Nasdaq. Growth stocks are basically the market saying, I believe in you, don't mess this up. Then we have value stocks. Value stocks are companies that look cheap compared to what they already earn. They often pay dividends, they are more established, and they don't rely as much on hype. They tend to move slower, hold up better during uncertainty, and they're less dramatic than growth stocks. Think of value stocks like the adults in the room. Then we have number 5, sectors. Sectors matter more than people realize because stocks are also grouped by what businesses they're in. These are called sectors. Some major sectors are tech, think Apple, Microsoft, etc. Then finances, think banks, lenders, credit companies. Then energies, think oil, gas, utilities. Then there's healthcare, think pharmaceuticals, hospitals, etc. Then there's consumers, think retail, food, brands. Then there's industrial, think manufacturing, infrastructure. So why does this matter? Because sectors rotate. When tech is hot, money flows into tech. When tech cools off, money flows somewhere else. That's why when the market can be red overall, but one sector is green and another is getting crushed. This is not random. It's money rotating. So when people say stocks are moving, the real question is which stocks? Large or small, growth or value, tech or energy, etc. Because not all stocks move in the same way or even on the same day.
Get better, my dog.